Welcome back after the break. You're watching Markets at Noon with me, Ankur Mishra and Mansi Dave. And Mansi, today markets is definitely in red territory. And for the viewers, to manage the portfolio, how should you navigate? We have with us Alok Agarwal, Head Quant and Fund Manager, Alchemy Capital Management. Mr. Alok, welcome to ET Now. Now you would have seen that on the expiry day, not much movement in the Nifty yet. I don't know what happened in the second half, what will happen in the second half of the market. But most of the viewers which ask question to us remains ambiguous, confused because of the happenings which is happening globally, and also the kind of volatile environment which has been there. On one day you would find market in green, on one day you will find in the red territory, and more than that, there is a limited movement in market currently. What is your assessment of Sensex and Nifty currently, and also is there any specific churning which you are seeing currently?
Pleasure being here. As you rightly pointed, the volatility has definitely gone up in the last few weeks and months. But frankly, as investors, given the kind of events this markets have witnessed in the last few months, we can't really be complaining. In this quarter, the previous quarter, it started off with that tariff announcements in the US, went on to that fatal attack in Pahalgam, to this almost a warlike situation between India, Pakistan, Iran, Israel. So many things happened in that quarter, and markets, despite with some volatility, actually kept moving upwards. So as investors, it's difficult to really complain to see that kind of bounce back and resilience in the markets. Fundamentally as well, the macro numbers have been improving, be it on the actions taken by the RBI, wherein they have cut the repo rates, the CRR, and ensured that the system liquidity went from a deficit to a surplus, and also the capex numbers being undertaken by the government and control on the fiscal discipline. So all these factors are coming together, and now we are seeing that collection and GST numbers improved, and the corporate earnings numbers are also improving. So things are actually shaping up pretty well. Yes, we are living in a world with a lot of developments happening both globally and locally, and hence slightly higher volatility is something that we have, that's a price that one is paying for that kind of news developments. But the markets on the whole look pretty resilient and reasonably strong for that kind of situation.
Hello, good afternoon, Mansi this side, and you gave a brief picture, a quick know-how of all that happened in the last quarter. And yes, I agree to the fact that we can't complain more, and the domestic markets are behaving very maturely to all of the global scenarios and global contingent uncertainties which are coming in. But we can't even negate the fact that markets are in a pause mode at present, of course, due to the global uncertainties. The markets are looking for a direction, Alok. Will the uncertainties wave more, or will the earnings season give the direction which the market is showing? And if yes, what are the sectors one should watch out? Because we are about to start the earnings season with the IT major posting its results today. Which sectors are on your focus radar?
Very interestingly positioned there. We are more constructive, to put it briefly, that despite the developments and the overall constructive situation in the markets, we are more constructive. But the interesting development that's happening in the markets is, even if you look at the previous quarter numbers, the Nifty 500 companies, they grew in the vicinity of 11 odd percent. But it was a top 50, the Nifty 50 companies, that grew at only 3.5%. The bottom 450 companies actually grew at around 20% plus. That kind of earnings growth was there. What I'm trying to imply is that some of the index heavyweight sectors are the ones that are seeing the slowdown in the earnings growth. And that is bringing down the overall aggregate numbers. And some of the sectors that are actually growing better, they are not adequately represented in the indices. To name them, for example, electronic manufacturing companies, the companies on some of the real estate, some of the capital market plays, some of the NBFCs on the non-lending side, as well as the lending space. We also have some building material space like cement, etc., and hospitals. So these segments, and to an extent, the tourism side, these segments are not adequately represented in the main indices, but are actually handsomely growing. But the index heavyweights, the likes of oil and gas, FMCG, the banking, and the technology space, they are the ones that have a heavy weight, heavy, big numbers in terms of the total profits, but are not really growing at a faster pace. So that's an interesting situation we are in.
All right. Also, Alok, I want to ask you regarding the sectors you mentioned. You would have seen IT and pharma today. What is your view on that in the light of what is happening in US? We don't know whether it's a deal or no deal.
Let's look at them one by one. In IT, certainly there has been some clouds on not so high growth as well. So apart from the fact that yes, with the advent of AI, there's always a question of whether that will impact growth or margins. Plus the implied issues in the US itself, which is the main market area for IT companies. So that's actually clouding the growth numbers for IT companies. But intuitively also speaking, even in the last 5-10 years, the combined growth number of the IT sector was not as great, whereas going forward, there seems to be more headwinds than tailwinds. But that's for the sector as a whole. But there will be some select players who would emerge as much better with better outcomes because of their own strengths. But as a whole, the sector actually lacks the growth which can propel it further. So that's why our stance is not very positive in IT. But when it comes to pharma is multiple types. You have generic pharma from Indian companies who sell in US. We also have CDMO players in India itself, which play a very crucial role. We also have domestic pharma and the hospital businesses. So we are more positive and constructive on the CDMO players and also very positive on the domestic hospitals. So those areas are growing much better and have a much better visibility as well. And that's what drives our positivity out there.
Alok, while I did deep dive in your style of investing, one thing with Alchemy Capital, which is for sure, is the focus is on identifying overheated sectors using the PEG ratio. Having said so, another debate which the market participants have in their mind is whether to be with the benchmarks or to shift focus to the broader markets. What's your view over there? Should one go to the broader markets because yes, one can even find opportunities, many good ones over there, or should stick to the benchmarks?
So in fact, more than focusing on whether we are with or without benchmark, as a house, we believe in GARP investing, which is growth at reasonable price. And so growth is a first word of that acronym itself. So our country grows at around 11 odd percent in terms of nominal GDP. And the corporate earnings are growing somewhere in the vicinity of 13-14%. Obviously, we would want to look at companies that are growing faster than that growth rate. So that's the number that we usually look at. So growing at faster than the overall economy and the overall corporate earnings. And yes, if you want to have growth plus good quality on both the balance sheet and the management side, obviously you got to pay some premium for that. And that reasonableness can be judged through the PEG ratios. So wherein we believe that a PEG ratio which is lower than the index is little more reasonable for the kind of premium that we pay. So currently, as we see, as we were talking, some of the index heavyweights in terms of sectors, they are the ones that are driving down the overall growth numbers. So majority of the growth actually is seen in some of those sectors which are not adequately represented in the benchmarks. That's why currently the answer may look like staying to find opportunities which are there outside the benchmark. But our outlook is not to look at with or without benchmark. Outlook is to look at companies that are growing much better, much faster on a more sustainable basis.
Alok, I want to ask you, how do you advise clients currently to navigate the market? Are you advising them to sit on cash? Because of course there is some uncertainty. There is also earning season which is kicking off from today. So will you advise to wait and watch till some signs emerge, or there are some sectors which you are saying that one can invest right now, and if yes, which can be those top 3 sectors?
So in India, it's a structural growth story. So, you can never really time the markets. How we would have judged, from September end to October till Feb, 5 months of correction happened for the first time in over 25 years. And at the end of Feb, it was so difficult to even imagine that next 4 months markets could bounce back the way they did. The fact is that India is a structural growth story, and any dip is actually an added opportunity to build up the portfolios. It's no point waiting. As a legendary investor, Mr. Charlie Munger had also said that the big money is not in buying or selling, it is in the waiting. So I would say that one should be invested at most of the times, ensure that they are invested. If they're going to the fund side, they invest in the right funds. If they're investing in the stocks, it should be in those companies which are growing at a reasonable pace. As long as that's there, you're in reasonably good quality stocks. You are there for the stocks itself will ensure that the things go up. But yeah, I would say, and the sectors that I said that the ones that are growing much faster, we are more positive on consumer discretionary space. Within that, also spaces like jewelry, retail, financial services on the capital marketplace, or also on the hospital side, the real estate side, the electronic manufacturing. And in the industrial side, we are more positive on the defense and the power. So these are the overall areas that are growing at a much faster pace. That drives our positive view there.
Right, Alok, thank you so much for joining in at this hour and sharing your views. But for viewers, we have an important update and announcement.